If you have discussed the idea of property investing with your friends and family, the chances are you have spoken about negative gearing and all the great tax benefits that it provides. But for those who haven't heard of the term or don't fully understand what it means, let me explain to you with a real-life example. John buys an investment property in the prestigious suburb of Toorak in Melbourne for $3 million. The property currently rents out for $1,200 per week, which is equal to a 2% rental return. John would then spend an additional 2% per year on maintenance and other outgoings, such as insurance, property management fees, council and water rates, plus 3% interest payments on the mortgage. In total, the property will cost around 5% of the purchase price to maintain every year. But with the rental return at only 2%, John is going to lose around 3% every single year. This is when negative gearing comes in. Because this is John's investment property, he's able to claim some pretty great tax benefits. He'll be able to subtract this loss from his income, meaning that he'll be taxed on a much lower income. This sounds pretty damn good, doesn't it? But what if I told you there was another method, another strategy that I have personally been using for the last few years to help me build a multi-million-dollar 8-property portfolio way faster than John ever could? Hey guys, welcome back to the channel. For those that are new here, my name is Zeng and I'm a self-made millionaire and real estate investor. In today's video, I'll be sharing with you my honest opinion about negative gearing, the pros, the cons, as well as an alternative strategy that I've personally been using to achieve my goals. This is going to be a video packed with content and a lot of useful information, so make sure you guys watch it till the very end. I'm sure you guys will get plenty of value out of it. Before we start, I just want you guys to understand that this is not financial advice. I am not a financial advisor. I'm just some kid on the internet. I want you guys to always do your own research and due diligence and consult with real financial experts before making any big financial decisions. And without further ado, let's get straight into the video. Let's start the conversation by defining our goals as property investors. The ultimate goal of buying any kind of property is to build wealth. Even if you're just buying a home to live in, this is still going to be one of your biggest financial decisions and commitments, so you should always treat it as an investment. With our goals defined, we now have to ask ourselves, what's the best way for us to achieve our goals? How do we build wealth through real estate? And what's the best strategy for us to get from where we are now to where we want to be? Now, if you decide to talk to your family about this, the most common suggestion that they will give you is to use negative gearing to pay less tax and then build wealth through capital growth. I'm going to be completely honest with you guys. I am not a big fan of negative gearing, and I personally think there are many strategies out there to help us achieve our goals much sooner. I have been using these strategies and I have seen the results, so I am living proof that these strategies work. However, because our circumstances are not the same, what works for me might not work for you. Negative gearing is by no means a bad strategy. It could definitely be very useful for some individuals, especially those with very high incomes. So let's go over the pros and cons of this strategy together, so we can decide if this strategy is suitable for you. First of all, the pros. The absolute best thing about negative gearing is the tax benefits. As discussed on the previous example, when John makes a loss on his investment property, he's able to subtract that from his income. For example, if John made a loss of $66,000 on his investment property and had an annual income of $150,000, he can now reduce his taxable income to $84,000, which is going to save him a lot of tax. As we can see in this report, by investing in Toorak, he will be making a loss of around $66,000 per year and have a negative cash flow of around $116,000. But with a growth rate of 8%, his property will double in 9 years' time, and if he decides to sell, he will make a net profit of $1.6 million. But bear in mind that he'll be losing $66,000 per year until then, which sums up to be almost $600,000. And this is also dependent on the property market performing well. This brings us to the first disadvantage of negative gearing. To take advantage of this strategy, you have to first make a loss. John is making a loss of $66,000 every single year in the hope that the capital growth from his investment property is going to exceed that. Personally, I think this is quite a gamble, because what if the property market takes a turn and his investment starts decreasing in value? It definitely won't feel nice losing $66,000 every year when the investment that you're paying so much money towards is actually losing value. Another potential issue with this strategy is that what if John one day loses his job? Because he's paying so much money to service his mortgage every single year. when he doesn't have that steady income anymore, he'll be forced to sell the property. And the final issue with negative gearing is how long it takes you to save up for deposits for your second property. Because you're spending so much money servicing that negatively geared property and your mortgage, it's going to be very hard for you to save a deposit for your second investment property. And even when you do save a deposit for that property, the third one and the fourth one is going to become even harder. In fact, for each additional property that you buy, you have to somehow come up with more income to service the mortgages because all these properties are negatively geared. I know what you guys are thinking. Alright, smartass, show me a better strategy. And I will. I will show you a strategy that I personally use to achieve financial freedom by the age of 26. But first, we must discuss the second way for you to get a return on investment from your investment property. And that, of course, is rental income. First of all, I'm a huge fan of investing for rental income because it is almost guaranteed compared to capital growth, which might be inconsistent and hard to predict. If you have the right property in the right location with the right rental returns and low vacancies, that property is going to do wonders for you, and it's going to make you a cash flow profit at the end of every single month. A good example of this will be the Hobart property market. There is a very serious housing shortage over there, and the vacancy rate is near zero. And as we can see here on SQM research, the vacancy rates have been hovering around that 1% mark for many years now. I have personally seen the effects of this massive housing shortage down in Hobart. My investment properties in Hobart have not seen any vacancies for almost 3 years now. And the rental return on those properties have been growing very steadily over the last few years. Even though many parts of Hobart have seen significant capital growth in the last few years, there are still many parts of Hobart where the rental return is above 5%, giving you a very good cash flow in today's low interest environment. This will give you a massive advantage over other investors for a number of reasons. First of all, not having a negatively geared property is going to give you a massive cash flow advantage. Instead of contributing money towards your investment property every month, your investment property will actually pay you. This allows you to save up a deposit for your next investment property much sooner. Another advantage of investing for rental returns is that the property will pay for itself, meaning you don't have to contribute any money towards it every single month. And if you were to lose your job, you wouldn't be forced to sell this property. This all sounds pretty damn good, doesn't it? Having a property that pretty much pays itself off after 30 years and gives you a bit of pocket change at the end of every month. However, there are also disadvantages to a strategy that focuses purely on rental returns. First of all, you'll be paying tax on all the rental profits that you receive from your investment properties. Negative gearing will reduce your tax because you're making a loss, but positive cash flow strategy will lead to an increase in your taxable income as all the rental profits will be added to your annual income and taxed at your tax rate. While getting taxed a bit more is very unpleasant, it is not even the worst part. The worst part about a strategy that focuses purely on rental income is that it often leads you to markets where there will be very little capital growth, such as mining towns. I know you guys are probably sick of me. If I don't want you guys to use negative gearing and I don't want you guys to focus purely on rental returns, then what do I want you guys to do? Well, I don't want you guys to do anything. I'm simply sharing with you guys the pros and cons of each strategy so that you can decide which one works best for you. However, the strategy that I personally like the most and that I personally seen the most results from is a balanced strategy that focuses on both capital growth and rental returns. A balanced strategy that focuses on combined returns. To calculate combined returns, we simply add the annual capital growth to the rental yield. For example, Sydney had a combined return of 5.1%, which comprised of a growth of 2.6% and a rental return of 2.5%. This is a very bad combined return if you ask me, and we should be aiming for numbers much higher than this in our balanced strategy. If we look at the performance of Darwin, then we will see a great example of a combined strategy. With a growth of 11.4% plus a rental return of 5.4%, giving it a combined return of almost 17%. As you can see, by putting these markets side by side, Sydney is already at a disadvantage because the rental return is so low. Sydney will have to outgrow Darwin by at least 3% every year because the rental returns are so much lower. However, I'm not telling you guys to go out and buy in Darwin. There are many markets out there with the same good rental returns and good potential for capital growth, such as regional Victoria, regional New South Wales, Adelaide, Perth, and Tasmania. I've made a few videos on these topics in the past, so feel free to check it out after this video. Let's take a minute and define this balanced strategy. I think the first and most important aspect of this strategy is that our property has to be cash flow neutral or cash flow positive. And to achieve that in the current environment, we need to have a rental return of at least 5% or more. However, as interest rates go up and down, this number is going to change as well. But our goal should always to make this property self-efficient so that we don't have to spend any money servicing it. A rental return of 5% might sound very high if you live in Melbourne or Sydney. However, if we look outside of these major cities, I can guarantee you that you will be able to find rental returns in the 5, 6, 7 or even 8% range. The second part of this strategy is to filter through these high yielding markets and find markets with good capital growth potential. Obviously, capital growth is not guaranteed, and it is very hard for us to predict exactly how much growth we are going to see in a particular market. So I think the best we can do is to invest in markets with good strong fundamentals, such as population growth, internal migration, shortage of housing, good rental returns, low vacancy rates, as well as government spending on infrastructure. Finding the right market is going to require a lot of research, and you have to go through a lot of data from a lot of different sources. This whole process involves a lot of work, and you're going to do a lot of research and filter through a lot of data. Anything from the state budget to population growth and projections, the housing supply, housing demand, as well as vacancy rates and census income and employment data. If you're struggling to wrap your head around all this research that we have to do, and your experience in the property market is limited, then I would strongly encourage you to speak with a buyer's agent. To give you a rough idea of how well this strategy has worked for me, I will be using some numbers from my personal investment portfolio. This is the numbers behind one of my properties in Hobart. This property was purchased in 2018 for $320,000, and it currently generates an income of $420 per week. As we can see in the cash flow estimator, the property is cash flow positive and provides me with an income of around $2,000 a year, which does not sound like a huge amount. But remember, this is a balanced strategy that focuses on combined returns. If we look to the table to the top right, we will see that at a growth rate of 5% a year, this property will double in value after 14 years, which is very conservative, and the actual performance of this property over the last 3 years is around 10% per year. Not that I would recommend you to sell after 14 years, but after taking into consideration all the selling costs and taxes, you'll be left with a profit of $400,000. The best part about this strategy is what is shown in the table on the bottom right corner, which shows us who will be paying for the property. Even with a 2-week vacancy period included in our calculations, all the outgoings of the property will be paid entirely by the tenant through the rental payments. If we go back to the cash flow estimator, we will also see that we will only be paying tax on $2,110 per year, making this a very efficient strategy that minimizes our tax liability, but at the same time provide us with a property that services itself with great long-term capital growth potential. Based on a rental return of 6.69% and an annual growth rate of 10%, this property has a combined return of almost 17% per year, which is much higher than the 5.1% we saw in Sydney. If you guys want to check out the app that I'm using, I've left the link below in my description box. Alright guys, this brings us to the end of the video. I hope you guys now have a better understanding of the pros and cons of each strategy and have a good idea of which strategy is most suited for you. I always encourage my viewers to think outside of the box and come up with their own adjustments to what I recommend. So I would love to hear your thoughts in the comment section below. And if you have any questions or you wanted to have a chat about today's video, feel free to message me on Instagram at InvestWithZeng. I wish you the very best on your investment journey, and I'll see all of you guys in the next video.